Let's bring on board Geoffrey Wong, MD and Head of Global Markets at Asia Pacific Equities at UBS as well. Geoffrey, hi, morning, good to have you on the show. Let's begin by understanding your overall emerging market view. You've stated that despite valuations looking cheap in emerging market and they being on the verge of a structural turnaround, there could be pressure seen on emerging market currencies. What will lead to that pressure?
Right. Well, let me give a backdrop of where we think the emerging markets are. We believe we're at the tail end of a normal credit cycle. So the credit cycle really started in around 2002, 2003. And that was really a recovery from the previous crisis of 1997-98. So it took about 5 years to get to the bottom of the last cycle. And from 2002, 2003, we had a boom. And this boom lasted and should have ended around 2007, 2008. Now, but instead of ending, what we had was the global financial crisis. So rather than allowing a natural end to the boom, governments basically went into very stimulative mode. Of course, you had quantitative easing, which was a very big factor. But in addition to that, you had massive fiscal stimulus, particularly in China. Now, back to this boom itself. Now, this boom, you have all the typical things that go along with a boom. You have inflation. So as the times are good, workers demand higher wage rises. So for example, in 1 year in China, we had a 50% rise in the minimum wage. But throughout the region, we actually had rises in wages. In addition to that, you also have booming currencies. So for a long period of time, emerging market currencies, particularly like the Chinese yuan, appreciated quite a lot. Now, when you put together the two things, the rising wages and the appreciating currencies, of course, what you have is a loss of competitiveness. And this happened massively throughout the emerging markets. Now, with this loss of competitiveness, a number of things happen. Firstly, your industry becomes less competitive and your trade account starts to deteriorate. So your current account starts to go down. And of course, we saw the end result of that in around August of 2013, where we had the so-called Fragile Five, where those currencies came under attack.
Right. So, Mr. Wong, how has your portfolio strategy changed since the start of 2014 for Indian markets?
The point of 2013, we had some concerns about continuing weakness in the economy plus weakness in the currency. And at that point in time, the weakness in the currency in particular favored the exporters. So particularly the IT sector and the pharma sector. As we go into 2014, the focus more turns into domestic beneficiaries from basically this unlocking of capex, the unlocking of the projects. So domestic sectors such as financials become more interesting this year.
Geoffrey, how much would election change allocations to India? Because right now the average allocations benchmarked to MSCI are at about 6%. Do you think that could go up to 10% plus?
It's very difficult for us to have any advantage in calling elections. I think these polls on elections are notoriously inaccurate. So the pundits who are typically financial experts and MBAs actually have very little feel for what the people in the villages are thinking and how they will vote. So I would not make a big portfolio strategy change based on our expectation of the election. However, I think the more important driver for us is where India is in the macro. And as mentioned, we think India is at the bottom in terms of its macro. It's at the beginning of a new capex cycle. The elections should help in terms of unlocking this capex cycle. But even pre-election, we're already seeing some movements in terms of what the Cabinet Committee on Investment and so forth. They're examining major projects such as the POSCO project, such as Reliance's Ultra Mega Power project and so forth. So they're re-examining these and with a view perhaps of making the projects go ahead. And so we've already seen forward movement in the unlocking of some of the logjam, even without a new government.
Now, you like Indian IT. I've seen, if I look at your portfolio, you have Infosys and a decent exposure to Infosys. What do you make of the recent earnings in IT? Because clearly the kind of commentary we've got from Infosys is not all that encouraging.
Our view on Indian IT is quite independent of what will happen quarter to quarter. So we are not so concerned in the short run with some expected weakness. We feel that the underlying strength of the Indian IT sector is structural and long-term. So since the global financial crisis, U.S. corporations have underinvested in IT. So there is pent-up demand for IT, and whether it comes this quarter, next quarter, or into 2015 or 2016, to us it's still beneficial to the IT sector. And beyond that, we have demand potentially increasing in Europe and Japan as well. So we feel that it's more of a structural story rather than one that depends on year-to-year demand.
Geoffrey, where do you see value in the market? Cyclicals like autos, auto ancillary, metals, cap goods, power, infra. Which sectors have you taken exposure to, since Feb?
Yes, the auto sector continues to look interesting. That India is one of the underpenetrated markets for autos. The financial sector also begins to look interesting as the NPL cycle peaks and a new capex cycle begins. That would be very interesting for the financial sector also. Mid-caps and so forth are also very cheap if you're able to play those sectors. So the more cyclical sectors are beginning to look interesting in our view.
What's your view on banks and also NBFCs? Because a few of the NBFCs already have got a bank license.
So the banking sector to us looks interesting because of, as I mentioned, we think the NPL cycle is near its peak and the capex cycle is beginning. So that looks fairly interesting. NBFCs, it's much more of a selective story. I think in certain areas such as second-hand vehicle financing and so forth, there are certain niches where a smaller NBFC can actually eke out a very profitable niche for itself. But if we look in general, NBFCs also have their challenges. They are now being more tightly regulated. They have certain obligations, so the obligations to lend into priority sectors, the need to build up a deposit taking network and so forth. These are real challenges for the new licensed financial institutions. So I think it's very much a stock picking as far as the new financial institutions are concerned.
Geoffrey, there is the PSU ETF which has generated a lot of interest in PSUs in India. Do you concur that a new government could spell good news for PSU or policy-sensitive sectors?
In general, we continue to favor more the private sector companies, simply because the private sector companies have proven to be more nimble, generally more profitable. Now, to the extent that the new government is able to unlock projects in sectors, that's going to benefit both the PSU and private sector companies within those industries. So I think it goes across the board. Now, selectively, if there is a significant reform in the PSU, of course, that's positive. But until that happens, we continue to favor more the private sector companies.
So where do you see markets are slightly overpaying for current demand or the current earnings? I mean, where are markets mispricing growth? Is it pharma? Is it consumers?
Yes, consumer sector certainly is fairly expensive, and as the tide turns in the economy, the market may switch its interest into the more cyclical sectors, which would hurt consumer stocks. Now, pharma itself is not cheap, but again, I think it's very much a selective story.
Lastly, Geoffrey, how much potential do you see among farmers as those stocks have been, on a roll in India with M&A activity as well picking up and also opportunities opening in the generics as drugs come off patent?
Yeah, pharma companies have really been on a roll, and particularly some of them. So it's not been across the board. Some have had execution problems. Others have been very successful. Now, we can't expect this patent expiration environment to continue forever. The patent expiration environment has been very positive for Indian pharma. However, there are other opportunities. So still Indian pharma is not fully penetrating the US, and the Europe and Japan is still very underpenetrated for Indian pharma. So there's a lot of potential there. Another area of potential is in more sophisticated generic drugs. So, for example, injectables, transdermals, new forms of drug delivery, etc. And that has potential for better margins and new markets for these Indian pharma companies. So, yes, they've done well, but on a very selected basis, some of them continue to have good opportunities in front of them.